right? I'm going to be honest, guys. As long as we have inflation as high as it is, in fact, keep it simple. As long as the Fed predicts to raise rates, as long as their anticipation is to raise rates, we are going to stay risk off, continue selling the stock market or stock assets, continue selling cryptos, continue expecting even gold, right? Where gold historically was normally a safe haven. But now it hasn't even been acting like that, right? If you really look at how gold has been acting over the past 6 months, it looks just like the stock market, right? So even gold, right now, people are more lean towards going to the dollar as opposed to going into gold, right? So right now, the one safe haven that I consider, or at least two, is obviously the US dollar, definitely the big boy, but also government bonds and things like that, which is also considered safer plays what big boys are probably going to start investing into, right? So overall, guys, risk off sentiment is the way. Continue to sell these stocks, continue to sell these indices, continue to sell these cryptos long term, continue to buy the dollar long term, and you guys should definitely be in great shape.
Abel, incredible breakdown of sentiment. Show some love in the chats if you guys enjoyed that breakdown. Abel, can we take this worldwide and start talking about like central bank decisions and how it impacts these currency directions? You know, the yen, they have a very weak monetary policy. You know, they overprint. You know that they have negative interest rates. Their currency is not worth too much. Same with the euro. How do you feel like the central bank policies today are in fact impacting these currencies? And you kind of have like a longer term idea of where some of these major currencies are headed?
Yeah, I mean, obviously the Bank of Japan right now is, that central bank is completely doing the opposite of pretty much every other major central bank is doing, right? Every other major central bank across the world, you know, they're going through the process of quantitative tightening, right? They're actually tightening across the board. You know, they're making it harder for people to actually access money, right? And not just that, they're making it more expensive for people to actually access money, which is the whole point of that, so people don't do it, right? But yeah, you know, depending on the monetary policies of these central banks, yeah, these currencies are absolutely going to benefit. Great thing is, like, I've been buying GJ, I've been buying AJ, I've been buying UJ, all simply because of the fact that the Bank of Japan is still so behind the curve, right? They're still, again, they're still easing while everybody else is tightening, right? So they're still printing. They're still literally adding more currency, adding more money to their supply, which is not going to make the demand for that asset stronger, right? So we see the yen's getting destroyed across the board. But this is something I want you guys to keep in mind, right? The Bank of Japan, their CPI data just came out, I believe, last week. It actually did come out higher, right? I think 2.2. I forgot what it was, right? Yeah. But it did come out higher. As this does continue to go higher, the Bank of Japan, guys, is going to be forced to have to respond, right? They're going to be forced to have to act. Because right now, yeah, their currency is shit. Their currency is getting destroyed. The moment that they do decide to actually turn around and start to act and start to tighten and start to actually raise rates just like everybody else, the Japanese yen is going to absolutely fly. Like, it is going to absolutely fly, right? But right now, there's no signs of them doing that. The Bank of Japan is still very much strong on their decisions. They're still going to just ride this thing out. So overall, the Japanese yen is going to continue to be bearish just because of that. But the moment there's signs of change, it will fly. We have to be aware of that, aware of it.
That's one of those bigger macro plays and sort of like big turnaround plays, right? Is when the yen decides to finally turn around and say, all right, we can't keep sacrificing our currency to save the bond market. We have to save both. And then, like you said, the yen's going to fly. And so GJ crash, EJ, and some of those other currencies, we're going to see a massive crash in those.
Yeah, I agree. Now, again, keep in mind, though, right? There's also a difference between short-term and long-term, obviously, right? So I do believe that, yeah, once the Bank of Japan does start to obviously change their tone, we are going to see a lot of strength from the Japanese yen, but I still believe it's going to be short-lived, right? I don't think it's going to be like a whole overall change in the trend. The reason for that is because we also have to understand the difference between interest rates, right? Interest rate differential, guys, is a real thing. You know, foreign countries and foreign investors, when they're decided on where they want to invest their cash or park their money, you best believe they're looking at the central bank rates, right? To see which one is going to offer them a better return. The Bank of Japan is still negative, right? So nobody's going to want to put money over there. If you're comparing the Bank of Japan at negative rates to, say, the pound, which is at what, almost 2%, over 2% now? Like, what do you feel more comfortable with, right? I'm putting my money with the Great Britain pound, right? Just because I'm getting a much bigger return as opposed to putting it in the Bank of Japan and I'm losing money, right? So again, understanding interest rate differential is also very important for understanding the macro outlook of it. So yeah, right? Bank of Japan does start tightening a little bit, they're going to get some strength, right? We're going to see the Japanese yen start to bounce, but it's still going to be short lived because they're still not nowhere close to what these other central banks are offering in terms of interest rate.
So that's the real key, right? So it's not really about what Japan's rate is, what somebody else's rate is. It's all relative, right?
Yep.
So if everybody in the world is tightening right now and reducing the supply of money in the economy, but Japan's the only one that's still printing, that's why it's lagging behind so much. So what about the pound? The pound is the one thing I can't really put a finger on because they had a conservative government. They had Boris Johnson for a while. Conservatism usually leads to a strength in that currency because you're reducing the supply. But now they're kind of having a bit of a change there. Do you feel like they're going to stay conservative and stay to their ideals? Do you feel like the pound can crash? What's your take over there?
I mean, that's a good one, right? Because I'm also pretty torn between what I think, because obviously over there, they're experiencing a lot over there in the UK, right? Like their recession is going to be, in my opinion, a lot worse than what we experience here in the US, just because, again, their policies and just how they're positioned overall.
For sure.
So I think that eventually, I do think that they are going to continue to stay. I don't know. It's tough, right? It's really tough. Now, when I'm making a decision, guys, for these currencies and these central banks, like I'm definitely paying attention to obviously what their policies are, right? But obviously, whoever's in control over there plays such a big part, right? Now, obviously, Boris Johnson, I think he ended up getting voted out, didn't he?
Yeah. Vote of no confidence or something, which is basically like when they stop messing with you, they're like, all right, you're done.
So
you gotta go.
So do we know who actually replaced him yet or no? And if they're conservative or not?
Actually, I don't know.
Because that's going to play a big role, right? Because obviously, whoever takes his, depending on the outlook of whoever's taking that spot, they're pretty much going to influence that currency as a whole, right? So we really got to just see who actually is going to replace Boris Johnson, and then see what their policies are going to look like, and then from there we could possibly make some decisions. But I still think it's a little too hard to really predict right now for the pound because there's a lot going on over there.
It says Rishi Sunak, which the conservative MP. So Liz Truss. So apparently it's broken down between two people. Conservative leadership candidates compared. So it looks like they got two conservatives here in the running.
Okay. I mean, again, just the word conservatives itself should just at least give us at least a little bit of a clue as to what the policies could be following that, right? So, but yeah, it's definitely very, very touchy right now, especially with this whole new election that they're about to have as well. You gotta be very, very careful when these type of elections and these big changes that are happening, they're going to affect these markets, right? But again, I'm with you. I'm with you 100%, bro. I really am torn as well. I just been selling the hell out of the pound. That's just been me, right? And again, it's mainly just against the dollar. Everything else against the pound has been pretty much going bullish, I believe, longer term. But
it's kind of choppy, right? That's why GJ has been so choppy, I feel like, and some of the other, like GU has been very straightforward because the dollar has kind of been running that show. But the GBP is kind of just like in the middle space between all these other currencies. So we're waiting. My favorite thing that you said is that, well, it's not my favorite because it's going to sound fucked up once I say this. You said the recession is going to be worse in Great Britain than it is going to be here. I think you're right because this is going to be a European-led recession.
Yep.
Like, I just feel like the landscape over there is so weak that it's only going to take one little shake and the whole thing is going to come tumbling down. America's still pretty strong landscape. Labor market's still decently strong. So I don't think that it's going to hit us as hard as it's going to hit them.
Yeah, no, I agree. Just to touch on that labor market, right? Because again, at the beginning of last month, Jerome Powell came out, right, when recession was officially finalized, right? Two quarters back to back, whatever, right? I don't even gotta continue repeating it, but right. Well, when that whole thing actually happened, and they actually tried to redefine what a recession was, right? The whole thing that they were really relying on was the fact that we had a strong jobs market still, right? Like that's the one last hope that the Fed is trying to hold on to, right, to keep us, quote unquote, out of a recession that we're already in, right? Mm-hmm. But one thing that, again, the Federal Reserve is not telling the people is that the jobs reports is also a lagging indicator, right? So there's a lot of different things that have to happen first before the job market takes a hit. We're seeing all that stuff happen now, right? We're seeing higher inflation. We're starting to see interest rates going up, right? We're now starting to see, the the profit margins for a lot of these businesses are now starting to become smaller and smaller and smaller because of interest rates going up, because of all these different policies. So yeah, we have to see a lot of things happen first before the job market starts to take a hit. So again, do not let the news try to steer you guys in the wrong direction. One thing that I also got to bring up too, we do have midterms, right? Midterm elections is coming up. That's a huge, huge thing that we have to be aware of as traders. Because you best believe, even though central banks are supposed to be entities that are not influenced by outside entities, you know damn well that is not true, right? We know damn well that these central banks are influenced by high political figures. So we have to also keep that into mind, right? How are these markets and how are these central bankers going to respond, especially over here in the Fed? How are they now going to respond to the fact that we do have midterm elections coming up? We are going to have Joe Biden over here applying pressure to the Fed. We are also going to have other outside sources trying to apply pressure to the Fed. So we have to keep in mind that that is also something that's going to influence what actually happens for these currencies, especially the U.S. as a whole as well. Now, what do you think about that, Roy?
The two biggest threats, and I completely agree with everything you just said, the two biggest threats to the Fed, and I don't think that they're working with the central government. They're working with Biden, and Biden's telling them, bring them down, raise them up, bring them down. But what they can do is they're going to print a bunch of money in terms of stimmy checks, and that's going to exacerbate the inflation problem and give Jerome Powell an even harder set of decisions to make. And he's going to have to go even stronger, crashing the markets even more. And I think that we're just going to have, we don't have a choice but to go back on the quantitative easing system. We got to start printing at some point. There's no way around it. The Fed's taking $100 billion out of the economy a month, right? Because they're trying to reduce the amount of drag in the economy. If Congress wants to win the midterms so badly, because Democrats are getting crushed right now, that they're willing to send out some stimmy checks to help out the whole system, they're going to make Jerome Powell's life so much harder. And that's when we're really going to see the pain.
I agree. And you actually mentioned something too, right? About the whole, the easing, right? Which is pretty much them removing $100 billion a month. Crazy thing is, right? They actually announced that they were going to do that months ago. But if we actually look at it, right? At first, they were saying, again, it was around, I think 60 billion, I think $90 billion a month or something.
Mm-hmm.
Even though they did that, if we look at the actual balance sheet right now for the actual Fed, like we can see that obviously the market did start to turn around, right? Around April was around the high, and we did actually start to see the market turn around. But I actually seen an interview the other day that said that the entire process of quantitative easing, which is now, again, them allowing these assets or this debt to roll off their balance sheet, is literally going to really start now, right? So they talked about it months ago, but the whole process, like where they're actually going to start, like really, really removing 100 billion is actually going to be starting now, which they were supposed to start it months ago. But even if you look at the actual thing, like, yeah, we have this little, turn down where we see the balance sheet starting to go back down to the downside.
It's nothing big. It's nothing major.
It's nothing crazy, right? So we're now about to start to see the effect of them actually starting to reduce their balance sheets more and more.
Mm-hmm.
This is, again, something we have to be aware of, right? But yeah, look at, we see the inflection point. We see the high back there in around May, April, right? But we really didn't do much.
Yeah, and it hasn't even been like 50 billion that's been taken out. They promised 100 billion per month. Now the thing is, if you kind of look at like the big picture, we can't really be burning 100 billion a month for longer than, like, I want to say 6 to 7 months.
Yeah.
Before things really start to get hard on the economy, before labor starts to take a hit. And so that's kind of the timeline that I'm operating under, is that they probably have until the end of the year to continue to take 100 billion out. They got probably 9 months total. After 900 billion taken out, it's really going to start to drag the economy. That's when they'll have to pivot.
Yeah, I agree.
Oh.
Again, just keep in mind, midterm elections, I'm telling you, right now is not looking good for Joe Biden. So don't be surprised if, again, Joe Biden tries to do something. So again, I wouldn't be surprised, bro. Like, if something happens where they do start to at least hint a reversal of easing, just because of things like, obviously, midterm elections, right?
Oh, I get what you're saying. So
Joe Biden is not.
No, go ahead.
I was gonna say Joe Biden is not gonna want to go into midterm elections with the way the economy is looking right now. It just doesn't make sense, right? Right now, confidence for him as a president is extremely low, just because of everything we dealt with. But especially now, though, we're now cost of he lowered gas. He was celebrating gas going back down. I don't care about none of that, right? Overall, we're still dealing with 8% inflation. right? We're now
Exactly.
seeing again a massive downturn in or not a massive, but a major downturn in the overall markets. So right now it's not looking good for him, like at all, right? Like at all, where anybody could possibly come in and just literally beat him in the midterm election. So I think,
But
and it's just my theory.
what about energy prices, bro? What about oil down? What about we were at $5 at the gas station. People couldn't afford to even go to work. But
Yep.
now it's $3.15. Nobody's
Yep.
going to vote you out when that gas is at $3.15.
That's true. Why do you think they started to do that? Why do you think Joe
Exactly.
Biden was pressuring? Like he came out like 2 months ago saying you guys need to lower gas. Stop doing, like, he was literally yelling at bank or whoever owns these gas stations, like, yo, you guys need to lower. It's because of
Yes.
obviously midterm elections. He needed something, right? So lowering gas back down is something for him, but that's not enough, like at all, right? So it's a lot. It's a lot dealing with. Again, I'm not gonna say I feel bad because that's the job they signed up for. But yeah, this administration definitely came into a very tough position, right? A super
Yeah.
inflated market that was. I'm not gonna say it was caused by the last administration, but we had a super inflated market already. There's only so much that you can do to keep this market high and
I mean,
still try to deal with inflation, right? So
if we're going to go back to this is the '08 crisis. You can't print money for 10 years. And then on the 10th year, have a pandemic where you can see the balance sheet literally went from 3 trillion up to 7 trillion post, and then right now sitting at close to 10 trill. You can't print this much money into the economy and expect, smooth sailing. There's gonna have to be repercussions for this. I think that Jerome Powell is doing a great job because instead of actually using policy, the first half of the year he was using language.
yep.
He would say things like things are worse than they seem, inflation higher than ever, because he wanted the markets to crash in advance before the economy was weak so that they can kind of get it out of their system.